Where you don't even know if you're logged in.
Mm-hmm.
You know what I mean? Right, Dan? Are you going like, am I on the right spot or this and that? So if they come to this and they see this, they know.
Hello, everyone. Welcome to the What to Know as a First-Time Homebuyer webinar hosted by Greater Alliance Federal Credit Union. We should begin in a couple of minutes, so sit tight and relax and just, wait some time a little bit. I hope everyone's having a good Wednesday. It's super warm outside, which is really nice. Yeah, 10. All right, yeah, they can hear us. Okay, everyone, welcome again to the What to Know as the First-Time Homebuyer webinar hosted by Greater Alliance Federal Credit Union. Thank you so much for taking your time and coming to listen to us about this webinar, and we hope that you can get some value out of this. So again, welcome, and hopefully you can enjoy this. So we're just going to go to the next slide. Okay, so before we begin, I just wanted to let you know there's some webinar resources that you should keep in mind. You can always ask questions. You should have like a little platform on the right side of your screen, and there should be a drop-down for questions. You are more than welcome to ask questions throughout the entire webinar. We're going to have a Q&A session at the end where we're going to answer your questions. If we don't get to your questions, don't worry. We can respond to you later. But feel free to ask questions whenever you want about any of the topics for home buying. We also have a free guide that's available as a handout. You can download that whenever you want, and it just goes a little bit more detail to some of the stuff that we may not touch on in this webinar, and you can read that on your own and just enjoy that. Again, it goes over first-time home buying experience. We're going to launch some polls also as well. You'll see that during the webinar. It'll be really simple. It will pop up with a little poll. You can answer it, and then once we get about 80% of the people who answered it, we're going to show the results, and that should be a lot of fun to see where you guys are in the first-time home buying process. And finally, if you have to leave for any reason, or if you know of anybody who missed this webinar, you will get a recording after the webinar is over in your email, so you can always watch this again, or if you missed something, you can always go back and refer to this. So I'd like to introduce today's presenter as Patrick Faulkner. Patrick started in the mortgage business in 2002 following his service in the United States Army. After 3 years as the supervisor and direct manager with Champion Mortgage, Patrick became an external mortgage loan originator where he consistently originated loans at the President's Club level. For the past 10 years, Patrick has called Greater Alliance Federal Credit Union his home and has served in the membership as a home finance consultant, assisting members with obtaining financing for their homes. So he's an expert in this topic, and you can get a lot of value out of this webinar today. And with that, I'm going to leave it over to Patrick to go over today's agenda and start going over the webinar.
Hi, Brian. Thanks a lot. Hi, everybody. Again, just wanted to reiterate by thanking you all for taking time out of your day to come on board and participate in the webinar a bit. What we're looking to do from an objective standpoint is basically take it from a very simple level, a very easy to understand level, and give an explanation, kind of a step-by-step logistic, teach everybody a little bit about the steps that are necessary to walk, if you will, to take yourself to a spot where you're ready to purchase a home. Okay, so what we're going to do, we're going to go over some of the basics, okay, including, what a mortgage in and of itself is, because there is a lot of jargon in the industry, a lot of terminology that tends to throw people off or scare them a little bit, for lack of a better word. So we're going to dispel a lot of that, because the main thing that we want to put out there to you is a bit more of an, in addition to an understanding, but a comfort level as we move forward through the process. And the more that you guys all understand, the more comfortable you're going to feel, and it's going to delineate a lot of the stress that comes with putting together a transaction like this, okay? So we're going to talk about getting pre-approval, pre-qualified. These are some of the embryonic steps, prior to actually sitting down and buying a home and signing your name on all the documents. Some of the costs associated, what it's like as far as first-time home buying, again, some of the logistics, the actual process once you've found a property and you're looking to put together a loan, as well as techniques that you can employ to get yourself prepared, because I will tell you, and this is going to be a running theme throughout the presentation, the way you want to approach this, as with most things in life, but particularly when it comes to buying a home, is like chess. You always want to be planning 2 or 3 steps ahead, whether it be where you're looking to buy a home, so you're looking at the taxes, you're looking at costs, putting money away, what program is going to be best, coordinating it with a family support system, schools if you're planning on having kids, or if you have kids already, obviously with your careers and work. So, you plan ahead. A lot of times you can, prevent any kind of storms from coming your way. Fail to do so, and unfortunately, it's like anything else in life, you can find yourself running the gauntlet. So, we're going to coach you through that as well. At the end, we'll definitely do any kind of questions and answers. Like I said, I've been doing this a real long time now, and through the good times and bad times in the industry, so there's precious little that we haven't dealt with here. We'll go over some future webinars that are coming to kind of dovetail and connect all this, so it's a really nice process that Greater Alliance put together. And as Brian indicated, while we roll through this, these polls are not so much polls, they're just one quick question. It's multiple choice. We do want to make it as interactive as possible, so we'll go through and we'll go from there. All right, so let's jump into it. Right? Okay. So basics. Hey, what's a mortgage? It's a loan used to purchase a piece of real property on the land in which it sits. Hey, you know what? It's a house loan. Okay? You're buying a property. That's pretty much it. It's a big home loan. Okay? Why are they even call it a mortgage? It's just a terminology thing. Makes a lot of us in the industry sound and feel cool. But at the end of the day, it's nothing more than financing for a house. Okay? And that's it. It's not even dissimilar from a parallel standpoint to a car loan. You're buying a car. When you're buying a house, you make an offer like you make an offer at the car dealership. When you guys agree upon it, you have a contract. You put a little money down, just like with a house, you try and put a little money down with the express purpose of having a payment that's going to fit your budget. And then there's some closing costs, like when they walk you in the DMV and you talk to the finance guy who goes over all the fees for, say, your tax and tags and licensing. There are closing costs to putting together a mortgage. And then you sign the paperwork, you get your house, you get your car. So I know that was a kind of a quick rundown, but the reality is the key here is we want to make this as stress-free as possible. And if you look at it and take the perspective like, hey, okay, it's not that big a deal, all right? It is one of the biggest financial transactions that people complete in their life. It's right up there with bringing a child into the world, getting married, college, and, putting somebody in the ground when their time is up. So when you take those 5 things, you put them together, this is one of those things, and the object here is we want to help you make this stress-free, okay? So things to consider, like anything else, whatever you're financing, obviously the tip of the spear is going to be your credit, okay? You're going to look at your credit score minimally with the guidelines that us and most lenders follow. You need at least a 620 credit score. Now, you have 3 different credit scores. You have one with Experian, one with Equifax, and one with TransUnion. Contrary to popular belief, lenders do not take an aggregate or an average. They simply take the middle score. So if your top score is a 700, your middle score is a 690, and your lowest score is a 685, what they base your rate off is that middle score of a 690. It's not a blend. It's not an average. If it is you and, say, a partner on the loan, the 2 of you are buying a home together, they will take the middle score of the lower individual scores. Okay? Again, not a blend, not an aggregate. Doesn't matter who's making more money or who's had a job longer or what they do. The bottom line is if I have 3 scores and say my wife has 3 scores and my middle score is 700 and her middle score is a 670, the rate will be based on the lower middle score. Okay? It is just policy, nothing more. Okay? Other things to take into consideration. Nowadays, there's very little programs. They might be bringing them back soon, but as far as 100% financing goes, they're looking for you to have a little skin in the game, i.e., the typical Fannie Mae guidelines are about 5% down on a purchase, okay? As far as some other programs that we have, we're going to be introducing that we'll be discussing in next week's seminar about some LMI programs that afford a little less down, unless you put as little as 3% down in some cases, and my colleague James Goodman is going to be discussing that next week. But for now, the point of that statement is that from a collateral standpoint, you got to put a little bit of money down. There is no more 100% financing these days, okay? So they want you to have a little skin in the game. They're going to look at your monthly debt. This is called debt-to-income ratio in the industry. And what that basically means is it's just fancy mortgage talk for the affordability of the monthly payment. They're looking at it and saying, okay, if we give a person this mortgage payment, when I add to what they're paying on their credit report month to month, the monthly payments on, say, a car loan, some student loans, a credit card, just the payments. If I add up these payments on the credit report and I add up what we're going to do for a mortgage payment, can they manage this? Okay, and there's a percentage that they use, all right? So typically it's about 45% of the gross income. So as long as if you take 45% gross of your income, okay, your monthly income, you draw a box around it, basically, and this is how I teach it to people. Take 45% of your gross monthly income and draw a box around that number. Now, what you want to do is take the monthly mortgage payment that you're going to have for whatever loan amount you're requesting, and you're going to add that to whatever you're paying out month to month that's on your credit report. As long as the sum of those numbers do not break the number in the box or do not exceed the number in the box, more often than not, you'll be fine. So now you guys pretty much know what the minimum score is to obtain a mortgage. You know how much of an income you're going to roughly need from a percentage standpoint, because that's about the extent of the arithmetic. The other thing is people think all kinds of fancy numbers and calculus going on here. It's not. I pretty much just broke it out to you. And you're going to need at least 5% down, okay? And we can go into all that. I mean, these other bubbles on here as far as monthly debt and assets, we pretty much just covered them in those last few sentences, okay? So moving on. And again, we're going to go deeper into this in the follow-up webinar that we're going to offer next week, okay? For the most part, mortgage programs come in two flavors, if you will, a fixed-rate program and an adjustable rate program, okay? Fixed-rate program is very simple. It simply means that the rate that you sign on for at the time you sign the paperwork and get the keys to the property you're going to buy, that rate stays that way for the duration of the loan. So, for example, you can hear terms like 30-year fixed, 20-year fixed, 15-year fixed, or 10-year fixed loan programs. It's simply exactly as it sounds. If you have a 30-year fixed loan and say the rate is 4.5%, what that means is the rate and the payment stays at the interest rate that you signed on for the duration of the loan. The only way it could change is if you refinance into something else. Okay, and that's pretty much the extent of it. Okay, the benefit being stability. You always know what your monthly payment's going to be, so it does afford you the ability to plan and say, okay, well, I know that my mortgage payment's always going to be this. I know my monthly budget is X. I know my mortgage payment is always going to be Y. So now, for the variables like family time, family vacation, the rest of my life, okay, I know I got these two things covered, and it's always going to be the same, and I can plan in other ways. Okay. Now, as far as the other flavor, you have the adjustable rate mortgage, okay? Very simply put, the way these work is the interest rate remains fixed for a specific period of time from the inception of the loan, okay? And you'll hear terms like 10-1-30, 7-1-30, 5-1-30. Basically, the first number, be it the 10, the 7, or the 5, whatever that first number is, okay, is the amount of years that the rate remains fixed. That's the fixed period. Okay, the 1 in the middle, like just to use a basic example, 5-1-30, you write it out as if you're writing the date, 5/1/30. The 1 in the middle means that after that 5-year period is over, the 1 represents how many times the rate can adjust per year after that 5-year period is over. And the 30 simply means that's the amortization time. In other words, it's a 30-year loan. It's amortized over 30 years. So 5-1-30 basically means, okay, I start the rate at 3%. It's fixed for the first 5 years. Year 6, it can adjust one time. Maybe it goes from 3% to 3.25%, okay, or 3.5%, and then it can only adjust once, and it's that way for another year, okay. And then year 7 could come, and it can adjust again. There are also caps in place to protect borrowers, okay. Typically, there's a 5% lifetime cap, which means the most that the rate could ever go to. Let's say if we use that example of beginning at 3%, even if you stayed in that loan for a full 30 years, the highest it could ever go would be 5 points over that 3, so a maximum of 8%. So it is designed to protect the borrower, okay? Because as some of you may know, interest rates back in the 80s were around 16%, 14 to 16%. So the last thing anybody would want to see is somebody start off at 3% and then 5 years later get their loan juiced up to 12%, because nobody would be able to manage that. So they're there to protect you. Now, the benefit with the adjustable rate mortgage, most of them, as in the example I just outlined for you, begin with a lower interest rate than your basic fixed rate loan, okay? Also, it can go up and down depending on what happens. So it can come back down, can come back, it can go up. So that's the benefit there. It kind of moves with the market, right? The only downside is, again, you have to be prepared for those kind of fluctuations, because obviously the fluctuation in the rate is going to be the catalyst to a fluctuation in your monthly payment, and you need to be prepared for that, unlike with the fixed mortgage, like we said, where the payment is always going to be consistent, but the downside to the fixed is if rates drop, the only way you can drop down to that lower rate is if you decide to refinance. And again, we're going to go into this much deeper next week, but I just wanted to give the basic breakout, okay? So that's pretty much how those work, all right? And again, there's different models, like I said, 30, 20, 10, 15-year fixed loans. There's, 5-1, 7-1, 10-1, even a 3-1 ARM loans. So lots of different inceptions, but the basic core program are the two that we just outlined. And again, we'll go deeper into that in the next webinar. Okay, moving on. Okay, let's talk real quick about saving for a down payment. As obviously there are numerous ways you can do this. We just want to put some of the top 5 greatest tips, if you will, as far as creating and achieving this objective. Obviously, hey, listen, you want to determine the monthly amount you need to reach your down payment goals, i.e., put together a timeline. If you're telling yourself, hey, I want to do this within 14 months, I want to have X amount of dollars, this is pretty much savings 101. It doesn't have to necessarily be for a down payment. It could be a car, it could be furniture, it could be anything you're trying to save for, right? It is recommended, number 2, that you create a new home savings account. And, something about seeing a specific account designed for a specific purpose, as opposed to just setting up another savings account. I'll be honest with you, it worked for me, and I've seen it when I've talked to other friends who do it too. You see new home savings account. If you find yourself in a pinch where you want to snatch some money or some petty cash, you're less likely to do it if you see that it's under that titled account versus just, hey, I got an extra savings account that I'm throwing money in here. There is a psychological aspect to it that does tend to help, believe it or not. Also, using direct deposit, setting up transfers from online banking. Also, another good way, as many of you are probably aware through other vehicles like 401k and things like that, when it just gets sucked away and immediately gets put there, you're not even looking at it. It's just building, behind your eyes, so to speak. You don't have to keep your eye on it. You're not touching it. It's just building for yourself, so you're not even missing it. And it's going right through, so you don't ever worry about not doing it 1 week or 1 month or however often you're trying to put money away. It just happens, which is good because it keeps you consistent and keeps you moving toward your goals. If you can cut costs in other areas like refinancing other loans, you might have gotten a student loan or a car loan. If you can minimize that, obviously, refinance it into something lower, ergo, you're going to save more money per month, which again, in this domino effect that we're kind of outlining here, gives you the opportunity to put more away, right? So, again, number 5, save some bonuses, rebates, cash back awards. The net is, any way you can do it, you want to do it. There are numerous other ones outside of these 5, but we just thought we'd pop a few up there. I do think that number 2 and number 3 are very powerful ones, and probably the easiest way to keep on board and on track with what your objective is when it comes to saving. Okay, so with that being said, we have come to the time of our presentation where we're going to ask you guys a quick multiple choice question, and we'll take 15, 30 seconds if anybody wants to go ahead and click on that and what you think you have. It'll help us kind of gauge also for the next presentation, so that maybe that may be something that we zero in on and give a little bit more feedback to moving forward. So, like I said, we're going to give that about 15, 20 seconds, and then I'm going to move on with the presentation. Okay. Okay. So wow, already. So we already got some results in now. Looking at this, it's heavy on around the 5 to 10% range as far as what people have saved up. And again, not surprising. We are clawing our way out of this generation's depression. It is not easy to save money in this point, in this day and age, which is why we included that slide in the presentation. But hey, to those of you who are, that's great. There were a few answers where folks had almost 15% saved up. That's terrific too. Listen, it's like anything else, everybody's different. Everybody's loan and mortgage is different. Everybody's lifestyle is different. So, you do the best you can, and you just want to make it so that when you do get a home, you can afford and enjoy living there. Okay? Too many of the mistakes in the past 7 or 8 years when things got real bad in the industry was people were buying homes that were way outside their limit, and they were slave to the home. In other words, they couldn't do anything. They had no life. They're what they call house poor because they were taking on payments. They didn't have anything to put down. They were putting next to nothing down, and they were rolling with exquisitely high monthly mortgage payments, which pretty much jammed up the rest of their day-to-day existence, which made them miserable. So, like I said, everybody's got to do their thing. It's nice to see that a lot of people are, in fact, saving here. For those of you there are a couple of people who, still haven't really gotten into it yet, again, it's tough to do. You just got to do the best you can because every little bit counts. All right? So good luck with that. All right. So moving on. Okay. So basically what we were talking about from a logistics standpoint, and we kind of touched on this a little bit in the beginning, all right? The first thing you're going to do as home buyers is you're going to get pre-qualified or pre-approved for the loan. It's not a scary process. A lot of people get a little freaked out by it. But effectively what you're doing is you're going to do an application, and we can take it with you over the phone. You can do it online at the Greater Alliance website. You can even come in any one of our branches, and somebody will sit down and help you out, okay? And basically, that application is going to look at 3 things, okay? We do pull your credit. You guys need to know that up front right now. In order to get anybody pre-qualified or pre-approved, we got to pull your credit, have a look at that, okay? The application is going to ask you, are you working? What is your income? And you're going to fill that out. And the third part of the application is going to ask you, do you have any money to put down, right? Like what's your down payment? Do you have money set aside for the closing costs that are going to be associated with the loan? Now, what's going to happen is after we put all that together, if everything fits the guidelines that we have to follow, and I referenced some of that before, the 620 minimum FICO, the 45% of your income, like debt to income ratio, monthly payment thing, and some money down, at least 5%. If those all fit, then what we're going to do is we're going to issue what's called a pre-qualification letter, okay, or even a pre-approval letter. And there are different aspects to each letter, but either way, the overarching benefit to both is this letter does a few things. Number one, it lets you know where your strike zone is, if you will, when it comes to how much of a loan you can do, which in turn will help you determine, hey, how much of a house can I afford? Where can I go? What's going to make the most sense for me? What's my zone here as far as affordability goes? And third, and more importantly, it is your ticket into the game, if you will. In other words, you need a pre-qual or a pre-approval letter for any real estate agent or realtor to spend time with you, okay? Because the reality is that letter basically tells a realtor or a real estate agent, even a seller of a home, that you're a player in the game, that you have gone the distance and said, okay, theoretically speaking, if I make an offer on a home and it's accepted and I go through with this, there shouldn't be an issue with me obtaining a mortgage and therefore purchasing this individual's home. So you need this letter because it really is your ticket into the game, and it communicates to the other parties involved with the transaction that you are a viable candidate and somebody who can participate in the transaction, okay? I promise you, you can go all the open houses you want. You can call realtors and real estate agents, say, go to their open houses, walk around, and then they're going to ask you the same question. Have you been pre-approved? Have you been pre-qualified? And if you tell them no, they're pretty much going to be like, nice talking to you, okay? On your way. And that's pretty much how it's going to go. So that is step one, okay? Now, like we talked about in the prior slides that we were looking at, being proactive is key. Playing this like chess is key. Thinking a few steps is key. Before you do this, you really want to sit down and have a look at your credit score. You want to sit down and look at your finances and say, okay, am I presenting the ultimate or optimum image of my finances myself as I go through and do this? Okay. A lot of times I recommend to people like, hey, if you got heavy balances on your credit cards, knock them down before you start. Okay. Anything outstanding, taxes, things like that. These are things that can tax liens. If we just came through tax season right now. If you owe taxes, back taxes, liens, judgments, things like that, square them up, because if they're not, you're pretty much wasting your time, because they will have to be rectified before we move forward. So again, from a proactive standpoint, you really want to present the best you on paper, when looking at your financial portfolio, credit, income, debt, things like that. It will only benefit you. It will only benefit you. Okay? And again, if you have any questions, just fire away, type them through, and we'll keep rolling. Okay? Okay, so just to touch on credit a little bit, as I indicated earlier in the presentation, right, you basically have 3 credit reporting agencies: Equifax, Experian, and TransUnion. We utilize them directly when we are pulling somebody's credit. We don't use Credit Karma, Credit Pirates, anything like that. We go to source, all right, and they provide us a direct report that we utilize to determine the credit worthiness of the individual. Okay. Now there are different shades of credit, if you will. When you're talking about non-traditional credit, listen, just take a step back. We're in the business of trying to do loans for people. Okay. When it comes to somebody who might be on a threshold of credit, this is where things like non-traditional credit and other credit details, we want to try and make it work, and therefore, as I said earlier, you want to present your best self from a credit standpoint, and that applies across the board. Mortgage being one of the biggest, as we talked about earlier, the financial transactions you're going to participate in. It's a participation that's going to go on for the next couple decades for most people. So you want to be able to show me or my underwriter or the lenders, hey, listen, I have the chops, if you will, to handle this. Well, that's when they're going to look at a pattern, right? They're going to look for patterns in the past. They're not just going to look at your credit score numbers. They're going to say, hey, listen, how are they doing on this bill, that bill? You're going to provide bank statements to us showing that you have money for the necessary fees and the down payment. They look at your savings plan. Does this guy save money, or does he blow through his money the minute he gets it? Is he missing payments on a cell phone bill? Is he missing payments on these little things? Because if he is, how can we trust him with an $1,800 or $2,000 a month mortgage payment for a house? Okay, so patterns, they play a role. Okay, because you can have somebody who has stellar payment history, okay, on all things pertaining, car loan, credit card, never miss a payment, everything's terrific, but maybe they went to the hospital a year ago and the insurance, their insurance through their company jacked something up, and there was a medical collection on them that they weren't even aware of. And for some reason, their overall FICO scores got torpedoed. Well, an underwriter could look at that and say, wait a second. This individual has been terrific with their mortgage with their payments on their car, their credit cards, and so forth. They only got jammed up because of a $200, because the insurance company didn't process something. I'll tell you right now, all of us have been through that where, the medical, something pops on your credit you aren't even aware of, and it turns out to be an anchor, right? So that's why these other less tangible features play a big role, like establish good habits, establish a good pattern. Okay, again, I can't keep saying it enough. Present your best financial self, all right? Another way you can do that is you should be checking your credit once a year. If you talk to any underwriter, because we've also done first-time home buying seminars at the branches at night, and we bring an underwriter with us, and the first thing they would always say is, listen, check your credit once a year. Okay, you can do it for free. It doesn't damage your score, and that's how you uncover things that, again, accidentally shouldn't have been there. Something was paid. You have proof that you paid it, but it was never taken off, and then it hangs and it lingers. Okay, or there's just mistakes. You got something thrown on your report that was somebody else's. Lots of different things can happen. The point is, you always want to manage this and be sharp on it, because it can seriously impact your finances. If your credit score is weaker, simple. Somebody comes to me with an 800 credit score, and somebody comes to me with the bare minimum, the 620 credit score. Who's going to get a better interest rate? Obviously, it's going to be somebody with an 800 score, and therefore a lower interest rate is going to mean a lower payment. Why pay more when you don't have to? Okay, so that's kind of the message here. All right, moving on. Okay, underwriting components. Basically, it's just saying, hey, listen, what are they looking at? And this is when we talk about the affordability of the monthly payment. how do you substantiate the income that you might be indicating on your application? A couple different ways. If you're vintage, W-2 pay stub employee, you work for an employer, you get a paycheck every couple of weeks. It's simple. They'll look for a couple of recent pay stubs. Generally, it's a 30-day history. So for most of us, that's 2 pay stubs in a month, plus a couple of years W-2s if you have any kind of bonus or commission that you earn. Okay. If you're self-employed, they're going to look for tax returns because obviously most self-employed individuals don't cut themselves pay stubs and W-2s. They would simply look for personal tax return and business tax returns. For those folks who have things like Social Security, disability, there are lots of other forms of income. All of these things can be utilized, just so you know. Child support, alimony, these are all forms of income that can be utilized, all right, as long as it is supportable on paper. Typically, if it's lawful and you can substantiate it with paperwork, you're good to go, okay? And that's pretty much it, okay? As long as it can be verified, you're solid, okay? And that's what they use to determine your debt-to-income ratio. Like I said, we went through that exercise a bit earlier. And if you have any questions, again, we can go through it again at the end. All right? All right, moving on. Okay. One of the things that is going to have to be done when you guys buy a home or you get into a sales contract with somebody to buy a home is, as the lender, we need to appraise that property because that, of course, is the collateral to the money we're going to lend you, right? So if somebody comes to me and says, "Hey, Patrick, I'm requesting a mortgage. The property's worth $300,000, and I want to do a loan for $275,000." I say, "Okay, I need to appraise that property. I need to have that property evaluated because that property's got to be worth at least $275,000 because that's what I'm lending you, right? So that property has to collateralize. That's what I mean when I say that. It has to be worth at least what I'm lending you, okay?" So we send an appraiser out there, okay? And basically, it's very simple. We send the appraiser out. Typical cost, it all depends on the size and location of the property, okay? Obviously, a 3-bedroom ranch is not the same as a 5-bedroom center hall colonial, okay? That cost is going to vary, but basically, it's generally between $400 and $500. An appraiser will go out to the property, put together a comprehensive report. We do send a copy of that report to you as the buyer who's buying the home. You definitely want to have that, because it is your property or soon to be your property. And we'll also use that and add it to the file to be used to qualify you for the loan. The report is typically good for 4 months, okay? So after that, it's not to say that the value or anything has changed in your home. It's just saying that were you to do another appraisal or find the need to, which you really wouldn't, that's about how good a loan is valid for, okay? But again, we handle all that. Just so you know, I know there's been some misconception out there that people think that the appraiser works for the lender. He or she does not, because that would be collusionary or conflict of interest. The appraiser has to be an independent third party. So it is one of the things in the process that we order externally, and we're kind of at the mercy of when the appraiser gets that report back to us, which is why when they reach out to you, the buyer, we always recommend that if the appraiser says he can be out there or she can be out there on such and such day, try and get that booked as soon as possible to keep things moving. And that's about it as far as the appraisal report goes. Okay. Okay, and again, we touched on this earlier, harkening back to the play it like chess thing, things to consider. Again, we're going to talk next week in the next webinar, I keep saying seminar, my apologies, about the best plan to fit your budget as far as what program would work. My colleague James is dynamic. He's going to go through all that and really put together a solid, comprehensive program for you. Earnest money, again, it's basically fancy talk, mortgage talk for, hey, when you come to an agreement with a seller, you're going to put a little bit of money down, and that's just, again, exactly what it sounds. A little bit of earnestness. You're saying, hey, I'm showing legitimate interest here, and I'm going to put a little coin down to let you know that I'm definitely interested in, and I want to pursue a transaction with you. That's all it is, okay? The down payment, again, keep it analogous in your head to that of purchasing a car, okay? And it just feels a lot more comfortable. The details are there. The parallel is there. The down payment, you're basically going to say to me, the lender, hey, Pat, again, to use the example we just did, the property's worth $300,000. I'm going to put $25,000 down. I only want a loan for $275 because that payment will fit my budget. You can do 20%, and we'll touch on the benefit of that in just a second. But hey, A lot of people don't have 20% in this day and age. Again, everybody's doing the best they can, but 20% on even a $100,000 loan is $20,000. Okay, and if the $200,000 loan, now you're talking about 40 grand. So listen, you do the best you can. There's nothing wrong with putting 5% down, 10%, 15%, whatever you can. Okay. Closing costs. The benefit with Greater Alliance is that we really don't have any closing costs. Okay. Now, what I mean by that is simply this: there are things that legally and logistically need to be completed in order to lawfully originate a mortgage loan, particularly in the state of New Jersey. For example, we just talked about one. I have to have an appraisal on the property. Okay. But the way we operate is similar to that of a contractor who might come out and build you a deck. Contractor comes out and says, hey, listen, this is what the cost is going to be for, the wood and the nails, not for the labor, okay, or anything else. Greater Alliance operates like that. For example, I've been with them now for just about a decade. I am not commission-based. None of our people are commission-based. Okay, we don't do nickel and dime fees like origination fees and application fees and rate lock fees and all that nonsense. That's not how we treat our members, and as all of you are aware, we're a very member-centric organization. So the objective here is pretty much simple. We want to help you out. We want to put a mortgage loan together, okay? And hopefully, by virtue of the way we operate, you're going to turn to a friend or a family member and say, hey, listen, these guys were at Greater Alliance, were terrific. Go to them if you want a mortgage loan. So basically, the way we operate is there are things that legally need to happen to put together a loan. Like I said, the property needs to be appraised, okay? We need to have title work done, meaning the property that you're going to buy and the lot and block number that it sits on, that all has to be registered to you and has to be insured, okay? When we run your credit, we utilize an external agency. They charge $25 a head to pull your credit score and send it over to us. So these are the things you pay for, okay? There's not, hey, 1% commission to Patrick and a $500 origination fee or none of that, okay? So this is one of the reasons why we typically come in anywhere from $2,100 to $2,400 less than a lot of other lenders out there, because all we're looking to do is take care of our people and put a loan together, okay? Next, home inspection. This is very important and not the same as a appraisal, okay? The appraisal is what we use and we need to have for our file. The lender needs to have an appraisal. And we use what's called a sales comparison approach. So what that means to you, to put it in layman's terms, is this. We send an individual out there and he or she looks at that property and confirms for us whether or not the value of that falls in sync with the other properties of similar size in the neighborhood. So in other words, if it were to go up on sale, would it fall in line with some of the other properties of the same size and what they've sold for? Okay, and we use that so we get a gauge on the market and make sure it all fits. Now, home inspection is something totally different, but very important, okay? As important as the appraisal. This is something that you, the buyer, would do externally, outside of me, outside of anybody else. Once you get that contract, okay, you want to bring a home inspector in, and what they do is basically they look at that house from nook to cranny, okay? The electric, the coating, the wood, everything, the house, the roof, the furnace. They look at every angle, as I said, nook and cranny of that house, and they compile a report to let you know, okay, hey, listen, roof looks good. You probably got another 10 years on it. Furnace, well, you might get one more season. They're that good. They're that detail specific. It's a terrific report to have, and it lets you, the buyer, know what you're walking into. Okay, and a lot of times, this report can help you if you need to renegotiate things. I will give you my own example. When we bought our house, we were told the furnace might have another year in it. The seller at the time was loath to go buy a whole new furnace and have all that move in, the time it would take, because he had to move out. So he simply reduced the sales price of the property to us by about the cost of a new furnace, which was about $5,000. So the home inspection is key, and what the report does typically is the inspector will put at the front of the report, so you're not digging around through the 20-plus pages that it typically is, the top 10 items that he or she, after inspecting the house, sees as the most important things that you need to pay attention to. And again, it could be, hey, roof, year and a half. Furnace, only has 5 months. The electrical in this one room is not up to code, could be a fire hazard. That type of thing, okay? So that's the home inspection. It's completely independent of the transaction you would do with us, but a very, very pivotal piece of documentation that you definitely want to have done, okay? Extra expenses. Hey, listen, this can vary in lots of different directions. For example, taxes. You're gonna, as I told you again, harkening back, I can only say it so many times in a presentation. Play it like chess. Let's just talk New Jersey. Taxes in places like Jersey City, Far Hills, Summit, they can ring up to $23,000 to $25,000 a year, broken up over a month-to-month basis. That's like adding $2,000 to your mortgage payment. Okay, if you add that in there, and then there are some places where taxes are $6,000. Okay, so look into that. Very popular now. People are buying townhouses and condos. These locations come with what are called homeowners association dues. Okay, and again, there are some that I've seen where, and then speaking from my own experience, townhouse that I have, the homeowners association dues are $215 per month. There is a townhouse community in Madison, New Jersey, where the townhouses themselves sell for between $900,000 and $1.2 million. The homeowners association dues for that particular location are $850 a month. So again, do your research, plan for things like that. Okay. Like I said, it goes through the whole list here. Commuting expenses, maintenance, things like that, utility bills. I mean, I'll tell you, the typical rule of thumb is even when you buy your home, after all the closing costs are paid and the down payment, you still want to have at least 2 months mortgage payments on hand. Okay. In case somebody gets sick, somebody's out of work, whatnot. And it seems daunting, but it is the best way to protect yourself. Okay. So that's it as far as extra expenses go, but there's a myriad more. But again, the rule, the overarching reminder is, again, play this like chess and plan ahead. Avoid the gauntlet. Okay, this screen is basically a breakout of what a typical mortgage payment would consist of. Okay, first two, pretty self-explanatory, like any loan that you finance, be it a car loan, furniture, big screen TV, you have your principal and interest. Okay, you have an interest rate on money that's lent to you. One component of your monthly payment is going to be the principal that you're paying back. The other is obviously going to be the interest. So those two are pretty simple. When you buy a home, you now own real estate, which means you pay real estate taxes. Okay, so that's the taxes part. Right? Also, when you buy a home, when you have a mortgage on said home, and you want to have it, either you do or don't, but it's definitely mandated when you do a mortgage with anybody, you have to have what's called homeowners insurance. Okay. Again, designed to protect you should something happen to the house. These are all mandates. Now, the bottom one, and I referenced it a few slides ago with regard to if you can't put 20% down, all right, you will be subject to an added premium that's called private mortgage insurance. Okay. It is not a bad thing. Number one, a lot of people see it and they're like, no, we have to put 20% down. We can't have PMI. That's terrible. Private mortgage insurance, it's awful, blah, blah, blah. Listen, if everybody was putting 20% down, we'd probably be doing one loan a quarter. Okay. The reality is a lot of people don't have 20% to put down. And PMI is a basic premium. It's not designed to push anybody out of being able to afford, the mortgage payment or anything like that. And it is a temporary thing. Okay. As you pay down your property, okay, once you get to the point where the loan balance is about 78% of the property's worth, or what they call loan to value, it drops off automatically. So it's a temporary thing, and you're saying to yourself, well, what's the point behind this? Why is it there? It's there to protect the lender against the default. Okay, plain and simple. All right. And once you've gotten to the point where you have just about 20% equity, it goes away. All right. And generally, if your next thought is probably, well, how much is it per month? The reality is it's different for everybody. Okay, because it's priced. The pricing on it is predicated upon your credit score. And it's also based upon how much you put down. Obviously, if I can put down 15%, my mortgage insurance shouldn't be as high because it's less risky as somebody who's putting down 5%, right? And maybe my credit score is an 800 and their credit score is a 690. So as you can see, it's going to vary based on everybody's situation. But I will tell you that aggregately speaking, and I'd say a $200,000 loan, mortgage insurance might be what? $70, $75. Okay, so it's not designed to say, oh, forget it, this mortgage insurance just put me over my budget. Okay. While we're talking about this, just one quick, again, mortgage term that people think they know or sometimes hear and they get a little confused by, and that is the term escrow. okay? As first-time home buyers, typically the lender is going to mandate that we escrow your homeowner's insurance and real estate taxes. And all that simply means is this. It's very, very simple, okay? Escrow simply means we're paying your taxes and insurance for you, okay? And an escrow account is really easy to solve because the other part of this is simply this. Your escrow account is simply what are your real estate taxes per month? What is your homeowner's insurance per month? Okay, that's your escrow per month. So quick math example, if your taxes are $12,000 per year and your homeowner's insurance is $1,200 per year, so the taxes end of it, if it's $12K per year, that's $1,000 a month, right? 12 months in a year. If your homeowner's insurance is $1,200 a year, being 12 months in a year and you divide it, that's $100. So at the end of the day, your escrow per month would be $1,100. Just that simple. But when people hear the terminology and the jargon, they freak out. The reality is, that's what escrowing is. I'm simply saying to you, you're going to make a mortgage payment to me for the principal and interest of the loan, and I'm going to add, say, that $1,100 on there, and I'm going to pay the tax man for you, and we're going to pay the insurance company for you. So you make one payment to make it super easy. That's it. That's the whole escrow mystique explained in about 2 sentences. It is, what are your real estate taxes and homeowner's insurance per month? Okay? So that's that. All right, moving on. Okay, again, like we said earlier, I'll just top that thing with the asterisk popped up. It's important that what you do fits into your budget. I said it before a couple of times in a couple of different ways. You want to be able to enjoy your life, okay? You want to have a home, and that's great. And, you know, if the difference between feeling stressed out at a mortgage payment is 6 or 7 months worth of savings, I will tell you my recommendation, and most homeowners, you know, tell you the same thing. Wait it out, save the money, and do it right. Okay, go into a home where you love your home, you love your life. You're not sitting there saying, I'm toast, I'm never going to be able to afford this. Or I can only afford to decorate 3 rooms in my house. Okay, that type of thing, because we've seen it happen. All right. Again, just going through some of the basics here. Like I just said, you know, as a first-time home buyer, it's not just about your needs for houses. It's your life. You know, what are your needs and what do you want? Okay. You know, a lot of this common sense. You know, work with professionals. When it comes to a real estate agent, I will tell you, not a bad idea to go through the friends and family network. Somebody you trust, mom, dad, you know, brother, sister, close friend. Hey, who did you work with when you got your house? Oh, somebody's always willing to give you a referral. Okay. As far as first-time homebuyer programs, again, my colleague James Goodman is going to go through a very dynamic webinar next week on that, and we can bring everybody up to speed on some of the details pertaining to that as well. Okay. So again, just kind of recapping here, the process in and of itself. Go online. There are plenty of places online. You're Trulia, realestate.com. You can look at different houses, or just take, you know, listen, I'll tell you, if you're in New Jersey today, it's gorgeous, 80 degrees, sunny day. Nothing nicer than hopping in a car and taking a ride through town, looking at, you know, houses that might be on the market, get a, you know, an actual face-to-face look. When you are ready to make an offer, that's when you're going to have your real estate agent with you. The real estate agent will convey to typically the seller's realtor or real estate agent what you're looking to offer for said property. Once that offer is accepted, they're going to draft what's called a sales contract that yourself and the seller are going to sign. That's where the earnest money part comes in, where you're going to put a little money down to let them know that you're definitely interested and that you're serious about your offer. And then you're going to apply with us, and we're going to start putting everything together, and you're going to start scheduling your inspections. Okay, those are like the basic 4 steps. But I will tell you this. When you do that pre-qual, and that should have been on the screen, you know, ahead of it, I will tell you that. You want to get that pre-qualification done first, and then from there we'll have you, and we'll be holding your hand through the whole process. Okay, because we're the ones who send you the pre-qualification letter. We'll email it to you directly after you do that application. So if you want to do, you know, step 0, then 1, 2, 3, 4. 0 would be do that pre-qual application so that you can come with us and we can walk you through it together. So there's no stress. Okay. Okay. Some of the programs that we are offering here at Greater Alliance, okay, is again, we were talking about, hey, it's hard to put, you know, 20% down, 15% down, just helping you save, okay, Greater Alliance has a couple different programs, and what we want to do is we wanted to put some incentive-based ideas together to reward our members specifically. A couple quick things at the bottom. We have Green Path's Homebuyer Counseling and Education Program. They are a supplemental group that can help educate and help you prep and plan. And again, this is more about making sure that your debt and you're putting your best foot forward financially, as far as making sure everything's tight on your credit and things like that. Teaching you a little bit about budgeting and so forth. Second step, like we talked about, is what I just referred to about getting pre-qualified with us, so we can put something together for you and begin holding your hands and walking you through the process. Greater Alliance, we have a terrific program now where we actually are looking to help people save for the purchase of a home, where you can, if you open up one of our home buyer savings accounts, you can earn, and if you're basically throwing $100 in there a month for 15 months, they're giving you 0.15 APY on the whole account. So you're going to make even more on top of what you're saving. And also, finally, we are offering a $1,000 credit to our closing costs when you do your mortgage through Greater Alliance. So lots of different ways we're trying to help our people, our membership, become homeowners, okay, and work together and make the dream a reality, for lack of better words. Okay. Okay, so as we talked about before, here's a quick roster of what's coming down the pike from the webinars. And again, we want to thank everybody for coming out. Next week is, as I said earlier, it's going to be types of mortgages and figuring out what's best for you. My colleague James Goodman specializes in, there's some niche programs for first-time home buyers that demand their own kind of webinar and seminar because of all the information that's out there. And James is our resident grandmaster as that applies. So he's going to be speaking on that on the 10th. And after that, we have some down payment options. We'll go deeper into what I was covering a couple slides ago. As far as 20% down, PMI, we'll go deeper into detail about that, followed by a seminar with the actual process as far as starting to finish and closing and things like that. And then just some of the benefits, May 30th, as far as renting versus buying. Right? So again, I want to thank everybody for coming out. I really appreciate your time. We do have, if anybody's got any questions, you can type them through, and we'll address them immediately. Great question. Okay, so the first questions we got, and this is a terrific question, how long is a pre-qual or pre-approval good for? 120 days. Okay, so you basically have 4 months from the time that you apply. We'll provide you that letter, and that letter is good for 4 months to go out shopping for a home. If the follow-up question is going to be, well, what happens if I don't find something in 4 months? You give us a call, and we can reissue it. We will have to pull your credit again because it falls in line with the credit report. The credit report is only good for 120 days. It does not cost anything. We just had that question pop up. Does it cost anything for a pre-qual or a pre-approval? No, it does not. Okay. As a matter of fact, through the whole mortgage process, you're not paying anything through the process. Okay, that's why they're called closing costs. All right. Okay, looks like somebody actually beat the other person to the question of how long is good is a pre-qual good for. So pre-qual, pre-approval, they're both good for 120 days. While we're waiting for more questions to pop through, I just want to clarify what the difference is between a pre-qual and a pre-approval letter. A pre-qualification letter basically means that the application that you guys do online, where we pull your credit and we look, and you can say on the application, okay, from an income standpoint, my employer is AT&T and I make $5,000 a month, okay, and basically we take your word for it. We say, okay, that's what they listed their income at, and they're saying that they have $10,000 in their Greater Alliance Credit Union savings account, and we're basically saying, okay, well, that's all they need to do the loan. So we're just, a pre-qual is based solely what's on the application, okay? Now, the stronger letter is what's called a pre-approval letter, okay? And a lot of times if you go shopping for a home, a realtor might ask you directly for a pre-approval letter. Even if you go out there with a pre-qual letter, they might say, this is great. Can you please get a pre-approval letter, which is the next step up, okay? Basically what happens with a pre-approval letter is if you want to change a pre-qual letter into a pre-approval letter, we just need you to show us verification of what you put on the application. So if you say I work at AT&T and I make $5,000 a month, we're going to say, hey, if you want a pre-approval letter, send me a couple of pay stubs to back that up. Okay, if you have money in your Bank of America account or whatever account to close the loan, you got $50,000 in there, we're going to say, hey, send us a quick bank statement showing us you got the money. Then we can amp it up, for lack of better words, from a pre-qual to a pre-approval letter. That's the difference. They're both good for 120 days. Okay, next question we got is earnest money refunded if the deal falls through? That's a great question. I will tell you that answer can vary depending on when the deal falls through. Okay, there is a period of attorney review. There is a period, it kind of depends on what gets negotiated between the attorneys, and it also depends on the reason a deal falls through. Okay, a deal can fall through, 3 weeks into the process simply because something maybe was spotted in the inspection and there was some discussion and negotiation between the attorneys, and at the end of the day, the seller and the buyer just couldn't agree with it. And, no blood, no foul. There was nothing, bad about it. It was just like, hey, listen, we're not a fit together because we want to see this and we want to see it, and that's it. So in those types of scenarios, I believe, and I'm not an attorney, so I'm not telling you this as gospel or straight fact, but it's been my experience that if the reason a deal does not go through is a legitimate, clean reason, then typically, no blood, no foul, the earnest money is refunded back. If it's a matter of somebody just disappears off the face of it, and is just, not participating in what's going on, then I've seen the seller say, okay, we haven't heard from you. You bounced, you went dark on us, for lack of better words. Deal's done, whatever's done, and we're keeping the money, and that's it. But like I said, if it's a clean reason, which 99% of the time it is, that's why, you're fine. Okay, next question. I heard about a program where the credit union gave you $4 for every $1 you save with this money used for closing or down payment. Yes, that is a program. It is not a credit union-based program, okay? It is a program that is being offered. My colleague James Goodman is going to be speaking on that next week. It is a terrific program. Greater Alliance was offering it. One thing that we did come to realize is there was a specified head count that they were allowed to go to as far as those who participated in it, and there was a ceiling on said head count, which was part of the reason and speaks to Greater Alliance's commitment to its members that they came out with our program where they're looking to do a $1,000 credit and create a home buyer savings account to help maximize money that you save. I will tell you that James has been working diligently with the powers that be to see if they can elevate that ceiling as to how many participants are permitted, but it is outside our individual decision-making authority, if you will. Okay. Would the buyer need attorney, or would the buyer need their own attorney, or will the bank supply one? Great question. Here's what I can tell you. It's either or. Okay. Again, that as far as an attorney goes, I will tell you that I have 2 attorneys that have done great work for me in the past that I refer to people who are terrific. Otherwise, friends and family network, always a great way to look as well. All right. Next question is, okay, is any of this necessary if you, okay. So the question is, if you buy a home in cash, is any of this, I guess I'm assuming the appraisal and title work? No, because you're not going to have a mortgage loan, so you're not even going to be talking to me. You will have to pay taxes. You are going to want to have the property's title work put under your name. So you're definitely going to want an attorney, but a lot of this is not going to apply because you're not borrowing any money from a lender. So if you do have the cash option, you definitely want to have an attorney put the property in your name so that that's safe. And then you'll always pay taxes like the rest of us on the property own, real estate taxes. So again, I think we're going to wrap up because we're just about a couple minutes away from the 3 o'clock hour. Again, want to thank everybody for coming out and taking the time to hear us. If there is anything, you can reach out to Greater Alliance anytime. You can give us a call, and if there's any questions, just refer to this webinar. And we'll get back. We'll get emails out to folks. But again, thank you very much, and look forward to catching up with you guys soon. Please definitely sign up for James's seminar next week. It's going to be terrific, and it's going to be very informative.
So that wraps up the first time home buying webinar. Thank you everyone again for coming, and I hope you got some value out of this. If you have some time, please make sure to like us on Facebook or follow us on Twitter. You can check us out on YouTube for some more videos. And again, just like Patrick said, we have a home buying webinar series for the month of May. Our next one is May 10th at 6 o'clock, I believe. So the link below, you can go to that to register. It's www.greateralliance.org/webinars. And hurry up because we do have limited spots, and I believe almost all of it's up, so we don't have many left. So hurry up on there and register for the event. And otherwise, thanks again for coming, and I hope you have a great rest of the day. If you do have any questions outside of this, you can always email us at info@greateralliance.org also. We're more than welcome to answer any questions you may have. So thanks again, and have a great rest of the day.